right, guys. So you know what to do. We are back at it. Mike Brown, you know what to do. You got to thumb it, like it. You got to subscribe it. You got to share it with your cousins. You got to talk about it at work. This is the kind of content that gets out everywhere, right? So today we got
Michael Plata from LoanDepot.
All right. So, so today I wanted to talk about, well, I'm always talking about stuff, but today I want to talk about what are the 5 biggest challenges that buyers face from a mortgage perspective. Because we know what happens on our side with realtors, but I want to know what happens when they come to look for the money. What are the biggest mistakes you see people make all the time? You probably see it all the time.
I see a lot of it, and I've been doing this for over 24 years, so I've seen the good, bad, and the ugly.
Oh, yeah.
So as far as 5 biggest mistakes, one is if they make any financial moves, right? Before closing or even before
the application process.
Application getting pre-approved, right?
Don't switch jobs.
Don't switch jobs.
We talked about that with Rob and another one.
But you could switch jobs if it's in the same line of work. Where it'll affect you, I've had buyers that they have aspirations to own their own business, and they've been working for a company, so they go from a W-2 employee to a 1099 or just self-employed,
K9, K1s,
business owner, right? And you have to have 2 years consecutive self-employed income, right? It can't just be that tomorrow I decide to open up my own business and want to get a mortgage. I'm
going to open a restaurant in Tremont and it's going to blow up immediately.
Right. Exactly. The other one I want to say is understanding your full monthly mortgage payment.
The PITI.
The PITI.
What does PITI stand for?
So it's principal and interest, taxes and insurance.
Absolutely.
That's your full housing payment that every loan officer will review against your income to determine what your debt to income ratios.
And what's that magic number with the PITI versus your income? What's the ratio that you look for to be in a safe spot for buyers?
So the maximum, and it all depends. Every loan program has different debt to income ratios.
Got it.
Right. Well, on a traditional conventional mortgage, the maximum is 49.9%.
Doesn't that sound high?
Where
half of my money is going to go towards my housing costs.
Where bigger banks, they have what's called overlays. So their debt to income ratios are much lower.
Got it.
Than what the federal government, which is Fannie Mae agency, allows.
That's right.
But in most cases, I do not try to max out the debt to income ratios because you're asking for a big problem down the road.
For disaster.
Right? Because anything could pop up.
That's right.
Right? Taxes could be much higher.
That's right.
On a house once we get the title report.
Your insurance goes up.
Your
water bill goes up because your kids just run the water all day.
How about if they're purchasing a condo or a co-op? You have an assessment that nobody brought up from the very beginning.
So this is what I really want to talk to you about because I have a buyer who's been looking at condos in Westchester County. And every single complex that we look at has a special assessment. Right. Even the townhouse complexes. Yeah. And the special assessments are almost like another maintenance fee.
At times.
You're talking about $300-$400, $700 in some buildings. Some have a semi-annual special assessment for the capital improvements. What the hell is going on in these condo buildings? What's going on, Mike?
Not just condos, co-ops too.
Co-ops too.
I've been seeing a lot of trouble with these co-ops getting financing because of critical repairs. Since what had happened in Surfside in Miami, Florida, that the building collapsed.
Right.
Fannie Mae has been getting more strict every year.
So it's like a trickle up. Normally, it's what happens on the West Coast gets us here. Now, what happened in Florida is coming up
from the South, and it's just going to the North and everywhere else, right? But it's more than looking out to make sure that there's no structural deficiencies that could impact, God forbid, something like, what happened at Surfside.
So are these buildings paying for extra insurances or are they paying for extra checks? Are they going through different assessments?
An engineer's report has to be done, right? And if they find that there are critical repairs that are required, then they have to start hiring construction companies or other companies to come in, give an assessment. Once they have that bid, they have to figure out who's going to pay for it. Right. Sometimes they have enough in the financials or in the budget to pay for that. Sometimes you have assessments that come up. Right. And these things got to get done.
Yeah.
Right. And
I'm looking at a building, 10 Stewart Place. I swear there are like 30 units for sale right now. Every week, every day I go on, there's a new one coming up for sale in there.
Like some of these buildings have garages.
Right.
down below.
Underground.
Right? And these garages now I'm seeing that need repair.
Yeah.
The garages.
Massive repair, not just painting and doing the numbers over.
And look, I'm not an expert in construction, right? But you have the building that is laying on top of the garage. Yeah. There's a problem with the garage that has critical deficiencies that has to get repaired.
We had a problem in White Plains. A garage fell down.
That's right. I do remember that. Right.
Yeah.
So, those things are a major issue.
Wow.
We're trying to get financing. Until those repairs are done, more than likely that co-op or condo is going to be considered non-warrantable, meaning it cannot go through
your Fannie Mae
agencies, agency lending, which is Fannie Mae or Freddie Mac. Right. So at that point, you got to look into probably non-QM.
Non-QM products.
Right.
And so when you do, so let's just say I'm a buyer and I want to buy this condo. I love this building.
Right.
And I have to buy a non-QM or I have to use a non-QM product. What's the difference in cost? What's the difference in payment, or is there one?
There is a premium in rate.
There's a
Rates
premium.
are typically higher. Down payments are bigger. Not substantial.
Okay.
Closing costs can be a little bit more. Maybe the same.
Okay.
Every scenario is different.
Okay.
But at the end of the day, it's as you said. You have a motivated buyer, has your down payment that fits a non-QM product.
Right.
It's an alternative, and down the road you could always refinance.
I get the feeling too, though, that these buildings you're going to see some negative impact in pricing because of all these assessments.
As everything else comes down to supply and demand, right? Too much supply comes onto the market. The demand decreases, and now you have
the demand will decrease because the monthlies just don't make any sense.
And then you have to readjust your values.
We were doing the math with her lender, and her mortgage was the maintenance plus the taxes plus the assessments were more than the mortgage.
Wow.
It just didn't make any sense.
Tough.
It's tough.
Yeah.
It's tough. So I'm foreseeing that many condo owners, if they're motivated or they want to get out of Dodge, they're going to take a haircut.
Yeah.
Or they're going to kick in and pay for some of these. They may pay for a year of assessments up front.
Some sort of incentive.
That's right, an incentive. That's right.
Right.
Because they're great buildings. It's just, I get it. A building falls, now everyone has to.
And, if you have a bad management company, they could make this more problematic.
Right.
Right. The other part also is not getting fully pre-approved early enough.
Yeah.
Right. There's some buyers.
And when you say not fully pre-approved, what do you mean by that?
I'm glad you asked that question.
He's like, God damn it. Because people say, I'm pre-approved, but did they check your credit? No, I told them.
There's some banks, right? There's a difference between being pre-qualified and being pre-approved.
Yeah.
You pre-qualified just means they took your verbal information, ran your credit, and gave you a letter saying you're pre-qualified. Most sellers and realtors do not want to work with that.
My verbal, so I make 190 and I have no debt and my credit score is 800. Can I get a pre-approval, sir?
Right, exactly.
And then when you really run the numbers, you're like, whoa.
Then when you have an accepted offer, and then when
it gets serious.
Then they actually take the application, take your documents, it's completely different of what was told to you, right? Pre-approval means that you did a full credit check.
Okay.
Looked at the income for the last 2 years, reviewed their documents, looked at their assets,
they sent you
bank statements, pay stubs, W-2s, maybe tax returns if you're self-employed, looked at the bank statements, ran the credit, ran it through what's called DU, desktop underwriting, right? And we could even take it a step further, send it to the underwriter to get it fully committed.
Because you have your own processing team, your underwriting team, so that's all in-house. You don't have to wait till someone does it and get back to you.
I could send that pre-approval to the underwriter to get it fully committed, and then we will have what's called a TBD commitment letter.
Got you. Just got to find the property.
Now you just got to find a property.
I love those.
And all we need is an appraisal and title to close. Right.
Now, on average, what percentage of your transactions are that versus people start the slow way and then finally work their way to getting everything into you?
I think it's a high percentage. I think most, and, it comes down to the loan officer. Just the loan officer explaining how that process works to the buyer. Buyer builds trust. They send all their information in. The loan officer does their due diligence. So I think it's a high number. I
hear you on the phone, and you're not a robot, but sounds like very yes, sir. And you're gonna need to submit 1, 2, 3, 4, 5, 6, 7. So I think when you're dealing with professionals, I think someone like yourself who takes it extremely serious.
Right.
When you're on the phone, every call is almost the same. Somewhat when I pass your desk, this is what you need, right? You're not winging it ever.
It's like any other professional, right? If you're looking for the right accountant, or maybe your doctor says you need to find a heart doctor, right? Just to get a heart checkup. Yeah. Right? You want to be recommended to somebody that is trustworthy.
Yeah.
And then when you find that person, that professional, they're able to educate you as far as what's involved.
Yeah.
Right? You want to feel comfortable enough knowing you understanding what the client's needs are.
Right.
Right.
Good point.
At the end of the day.
Because everybody's needs are different. They just don't. Some people just don't need a mortgage. They need some other things going on.
Everybody has different goals.
Yeah.
Right. And I've always asked that question: what are your goals with buying a property? Yeah. Is this more of an investment? What's your long road as far as what you're going to do with this property?
Right.
What are your goals down the road? As far as, is this a property you're going to have for 5 years? Do you see yourself living here for 10 years? That way we could structure this mortgage plan according to what
your goals
you need.
Are people doing 5-1 ARMs, 10-1 ARMs anymore? Is that a thing?
That's still a thing. Yeah. I mean, the rates are pretty sharp on those fixed ARMs. Yeah. Mm-hmm. I mean, you have mainly a financial savvy buyer that are looking into the 7-1 ARMs, 10-1 ARMs. 5-1 there's 3-1 and 5-1, and those are a little bit too. There's not enough life in that mortgage. You worry about something may happen down the road.
Got you.
So I think 7-1 and 10-1 is a safer amount of years.
Because you're locked for 7 years.
You don't have to.
You don't have to worry about it.
You can sleep at night.
That's right. And the way they just got a new Fed.
Yeah.
Not a political conference, but new Fed. You don't know what's happening.
Exactly.
There's so much uncertainty.
The other mistake I would say, using all your savings for the down payment. Right. You want to leave a cushion.
You need reserves.
Right.
Now, with the purchase of a home, you don't necessarily need reserves left over, but co-ops often require it, right? Or condos or
co-ops, especially the ones in Manhattan, typically want to see you have at least 12 months or a certain percentage of your income or
Garth Road too.
Right.
If you're in Scarsdale on Garth Road, they want you to have 12 months of reserves.
Exactly.
And a year's worth of this, and your income has to be 12 times. Right. No, I get it. It's funny though. I think the average home buyer doesn't understand why those parameters are in place.
You're one of the best realtors in this community, right? As far as a buyer, and you've owned a home, or you own a home.
You got me the mortgage.
Thank you.
Thank you, sir.
So once you get your keys, don't you have to furnish the house?
Yes.
God forbid something breaks down.
And it always does.
Water heater.
Yes. Your roof.
Right? Yeah. You're always going to want to make upgrades to the house. So you definitely don't want to leave yourself at zero.
Yeah.
Going into purchasing a house.
Absolutely. It's this, it's funny. I remember buying my first house and, we were bare bones then, right? Mm-hmm. But it's scary. As exciting as it is to own a house or buy your first home, I could see how scary that is to part with all the savings that you've had. You might have saved it for 10, 20, 50 years or whatever, however long you saved it.
To expand on that, it's a payment shock.
Yeah.
You're used to paying a certain rent every month, or maybe you live still at home. Right. And now you're taking on this big payment.
And it's normally double or sometimes triple what the people are paying as a monthly rate.
Exactly.
Like I have a good friend of mine, we were looking for a home for him. And that monthly number is a big difference than what the rently number, especially with taxes today. Mm-hmm. You're looking at a house in Westchester County. If the taxes are $10,000, $12,000, that's $1,500, $2,000, or $1,500 in just taxes alone per month.
I mean, look, when I started working here in the Bronx areas in Westchester, I remember the average mortgage payment was anywhere from $2,500 to $3,000 a month.
I could see that. What is it today?
Today, you're probably looking $5,000 to $6,000.
That's the average payment for a single family home in Westchester County?
Right, yeah. I mean,
I could see that.
What are average prices going for?
So, entry point, you're probably 7/8.
7/8, right? And if you put a low down payment,
I had to do
call it 5%.
7/8.
Not 6/7?
Not 6/7.
All right. So, if you're putting a low down payment, the minimum down payment plus taxes, what are taxes going for?
11.
So you're in for a good $5,500.
Easily $5,000 on the low end.
Right. So,
Right. Now, the other thing that I find interesting,
and by the way, that's not going to change.
It's not going to get lower.
I don't think so.
No.
I don't foresee it.
We talk about predictions, right? We always like, is this going to be, is the market going to correct? Right. What does the mortgage industry say today? What is the conversation you having at your team meetings with the other lenders and your higher ups in the financial industry?
Well, I mean, as far as where a buyer stands,
or where are we going? You think we're headed for a price correction? Because I know everyone's hoping we are. When I say hoping,
yeah, of course.
If you're a homeowner, you don't want the price correction, but if you've been sitting on the sidelines, you're hoping for a price correction.
You know, if history has anything to say, I think values have only gone down 4 times in the last 70 years, right? And the demand is still so high because there's a lack of inventory, right? And most buyers want to get in and purchase a home. I mean, usually that's the American dream, if it still is, right?
Right.
They want to own something. They want to build net worth equity.
Yeah.
And it's getting harder.
Yeah.
Because the house is more expensive.
Yeah.
But banks are always creating ways of how to get buyers into the door. Right.
You just touched on. I'm sorry, I didn't mean to cut. But you, this is a touchy, not touchy is, but so I was talking to a buddy of mine on Instagram. We were posted some content the other day about the changes here in the Bronx.
Okay.
And how fast is relative, but it seemed like we say gradual than sudden. So it seemed more sudden that the prices jumped here overnight.
Right.
And he had made a comment that a lot of it was due to program rentals. And that driving the rental cost or the rental income of that property, and yet making that property more expensive. And I could agree with that in some sense, right?
I could see that.
And I saw the same thing in the second home market, like in LBI or Southern Florida, where VRBO or Airbnb, the internet money, falsely inflated a lot of these properties. Right, so you see the self-correction happening in Florida. I don't see a self-correction happen in LBI. I mean, to buy a damn beach house is $2 million.
Yeah,
and it's just like when I first started going out there, they were $600,000. But the VRBO says I can make $40,000 a week during the summer.
I mean, I just think from after COVID, I mean, people are more wealthier today than they were before, and there's a large gap though. There is an income disparity.
The disparity's gotten wider.
Right. So,
and you think that
COVID
has made that wider?
Absolutely.
Wow.
I mean, look at today. Look at the market today. Anybody can make money in the market. It's up over 50,000 points. Right. I mean, if you have your money in the market,
you talking about the S&P or the Nasdaq, or just the market in general?
The market in general, right?
Oh, wow.
So most people have invested into the market. Others have invested into other properties that they purchased 5-7 years ago. Now their property's worth double. They sell, they move on to some other investments.
Keep trading up, 1031, 1031, kicking the taxes down the road.
So anyway, so there's more money to be spent where you have a buyer 7 years ago that only would have a certain amount to put down. Now certain buyers that took advantage of what happened after COVID, right? Now they have more money to play with, such as getting into LBI in New Jersey. It's buying a second home.
I never thought about that perspective. Very interesting. And so you're talking about a specific a segment, right? These are the wealthy people who've always invested in securities, financial markets.
Right. They just took advantage.
They took advantage of the times that we were in. And so they made more money.
They just doubled their portfolio or triple, 10x it. Who knows? But like I said, there's more wealth with certain segments, as you called it, that now they're driving up the prices for vacation homes. Yeah. Right? And such as places like New Jersey.
Right. Or you were talking about yesterday, the Hamptons.
Oh, the Hamptons. Right.
$5 million now for land.
Just for land itself. Right. Right. I mean, the average price.
But you're right, though. The wealthier got wealthier.
Yeah.
So that's driving the price of some of the premier properties, or any property, because the wealthy now can use that for an investment.
Let's talk about where we're at in the Bronx. Right? Before COVID, what was the average home prices going for?
Single family is probably in the 4s.
Now, what are they?
6, 7.
6, 7. I
don't know why that's such a thing, but no. I was just talking with a young lady today. She moved down to Atlanta in 1990s.
Right.
I think her family had bought the house in the 70s for 20-something thousand.
Right.
Sold it then for maybe 200,000. Now that house is worth 700,000.
Now what
Single
happens?
family house.
Now what happens? They sell. They walk away with 500,000-600,000. Right.
Right.
Maybe they use half of it to invest into other places in the country.
Yeah.
That doubles over time and it just keeps going and going and going.
And so what happens is the kids of those homeowners, because those are the wealth.
Then you have the generation coming up that the parents are leaving the houses to them.
And the kids don't want these houses. Or I'm using a blanket statement, but what we're seeing a lot is that the kids are not interested in the real estate that their parents held in the Bronx. Or in a lot of urban markets. Yeah. They may take the money and not run, but go do something else.
Use it to invest in something.
In something else. Yeah. Maybe they'll buy a place in DR, because they're very mobile generation.
Right.
They're not I haven't moved from New York in 30, right? Since I came back from college, I haven't left. Right. A lot of kids these days, they move here. They move,
and there's less kids getting married, having kids. Right. So as you said, the generation is a little bit different.
Yeah, a little more transient. Right. Not in a bad way, but they can move around more.
They have other priorities.
That's right. Other priorities.
Visions that they have that they see their lifestyle going in a different direction.
And it's funny thinking about that now, hindsight, or thinking about my kids. Is that something my kids are going to be thinking about? We don't want this old house in Westchester. We want to be in Florida.
I mean, it's hard to say because the economy changes from different presidents to, just different, we just got a new Fed chairman.
Right.
We don't know where the Fed's going to go moving forward. Right? Yeah. We can only suspect what they know about the new Fed chairman.
Something I want to talk about now that we're talking about the Fed chairman too, is that the misconception that when they have a rates increase, that affects mortgage rates. Can you tell them
that's a big misconception?
Right.
So anytime the Fed decides to cut rates or increase rates, they're not increasing or decreasing mortgage rates. The only driver for mortgage rates is the mortgage-backed securities, which follows the 10-year Treasury bond.
And so now talking about the bond market, there was a bond rally recently, right?
There was, yeah. Right. And every day it changes. Depends what headlines comes out in the news regarding, the war that's going on with Iran. So because inflation will either increase rates or decrease rates, and so with the job market, right? So with energy prices going up, it's causing inflation and everything, right? Because you need energy. Energy consumes everything in this country.
What was interesting? Oil makes plastic. So
it touches
makes everything.
It touches everything, and if the prices are more expensive, then interest rates are going to get more expensive.
Yeah.
Right. But as far as going back to the Fed chairman, when they cut or raise rates, they're cutting or increasing rates on short-term borrowing.
Credit cards.
Your credit cards, your personal loans,
car loans,
auto loans, your student loans.
What about small business loans?
Your home equity line of credits. Not so much your business loans. Right.
I'm just curious if
that's a different market.
Yeah. All right. So what do we have to do to get the 10-year bond down? Who do I have to call? What kind of activity?
You're going to have to move a lot of mountains for that, my friend.
What country do I have to call? I need you to buy a bunch of these bonds because we need to drive the price down, sir.
You could try. You could definitely try.
Now, how is the job market looking? From your perspective?
The job market's getting stronger and stronger.
Good.
Well, it's good in one ways, bad in other ways. A weak job market also helps rates coming down.
Got it. So a strong job market, people still making money, people still spending money.
Right.
They have no interest in decreasing rates because you're still spending the money anyway. If you're still buying a car.
If you're spending money, you may be increasing the prices of that product because you're not the only one that's spending money on that product. There's others. So the demand is there.
Yeah. It's crazy. I had bought a car in, 2026?
So far, yeah.
Bought a car in 2022. And my sister said to me, you must have spent a lot on that car. And I didn't think about it, but then the interest rates were really high on car loans. Now, my credit was a lot better than it was typically years ago, so it's probably all relative, right? The interest rate's probably not that high considering what I was paying on interest rates back in the day.
But you know what? You just made me think of something, right? We're talking about rates and home prices.
Yeah.
So if home prices are higher and rates are lower, that mortgage payment's going to be more the other way around.
More the other way around with the high interest rates and the lower lower payment and the lower number.
Right. Yeah. So it's always
because the bank makes all the money on the interest.
Not just that. It's I always say they always ask me when's a good time to buy.
Whenever you can afford it.
That or now.
Yeah. Because it's never going to be cheaper than now.
If you wait till tomorrow, if you're waiting for rates to come down,
that's right.
You're just going to pay more for that house, and your mortgage payment is going to be more.
Gary Keller says
purchasing today at a higher rate and always refinancing down the road.
We're making some lifestyle adjustments. Right? Maybe you don't go out as much. Maybe you cook more for at least the first 6 months. Right. Be mindful of it. Right. Gary Keller says one of the things that when people ask him, should I buy a house now? He says, can you afford the payment for the next 7 to 8 years? Mm-hmm. And now things being equal, you have the same job and all that stuff. Of course, we're going to be able to afford the payment. But if that doesn't match up, then you don't buy the house.
Makes sense.
And that made total sense to me.
Yeah.
Because a lot of things, to your point, could happen. The roof goes, this goes. Right. You lose an income. Your wife gets pregnant and is out, maternity leave for 6 months. Right. You lose a big piece. You don't lose your income in maternity leave.
All depends.
All depends on your yeah. What else? What else we got to talk about today? What are the other top 5 biggest issues? Did we touch on everything?
I think we touched on.
We touched on that. I'm just going.
Yeah, I think we touched on pretty much. And don't co-sign for somebody else.
Oh, that's Judge Judy's rule.
Don't
you don't co-sign for no car, for no boyfriend, no husband.
Don't think that's not your debt. On paper, if you co-sign to help somebody else, that's your debt. You're responsible for that, and that's going to affect qualifying for a mortgage.
That's right.
Right.
Lastly.
Go ahead.
And
also just be careful as far as large deposits in the bank. It's if it's cash, that could be a problem trying to verify where it's coming from.
What's your thought on non-married couples buying real estate together?
I mean, I can't speak on as far as
he says I'm not touching that.
Can't speak on the psychology behind it. But I
just wanted to start a little trouble today.
Right, but I mean, you could purchase a home. You don't have to be married. Yeah, absolutely. I mean, yeah. If they think it's a good investment,
right,
then it is.
It is, right?
Yeah, it is.
Do you see that a lot?
I see that a lot.
You do?
A lot unmarried couples, either friends or partnerships, purchasing homes. Absolutely.
All right, cool.
Yeah,
cool.
Yeah.
So get a house with your boyfriend.
Yeah.
Buy the co-op with your boyfriend.
Yeah.
You're paying rent anyway. Just buy the damn co-op.
Stop throwing the money out of the window.
Just stop throwing you love him.
Right.
You're just not going to get married.
Yeah.
Just right?
I mean,
that's a whole nother topic.
It's a whole different topic.
So you know what to do. Subscribe, like, heart. You want to do a heart? No, I'm not doing a heart with you. Share it with your cousins. Talk about it at work.
Right.
Let the world know.
That's right.
We're here to deliver great content about the real estate industry and just how to navigate the market. Thank you.
Absolutely.